People always ask me, Jamie, what properties do you invest in and what's the criteria? Well, in this video, I'm going to break it all down for you. More importantly, it's not just my criteria. We build portfolios for buy-to-let investors as well. So if you're looking to scale your portfolio, I would suggest applying the same knowledge. Let's start with yield. Yield is the most simple way of measuring a return on any investment, really, and they're called different things, but in property, we call it yield. Make no mistake, I am talking gross yield, not yield minus this, minus that, minus that, minus that. And you get some people go, yes, but you haven't deducted it. Yield is very simple. It's your annual rent divided by the purchase price. For example, if you've got a £150,000 property, to get a 7% yield, it needs to be £875 per month. 875 times 12 is £10,500. Divide that by 150,000, you've got your 7%. And we want to be following the 7% rule. Why is 7% so important? Well, first of all, you have to understand this is area dependent. It's 7% for me in West and South Yorkshire. Most of the northern cities, and even in Birmingham, maybe not Birmingham, all of the northern cities, you should be targeting around that. Make no mistake, in London, it's going to be difficult to do that. Now, it's difficult in West and South Yorkshire, if I'm honest. You have to negotiate. But the reason for me is I believe a great investment should make a bit of money on cash flow. We're not about to be quitting our jobs or making 10 grand a month from it or anything like that crazy stuff. But it should be enough to wash its face, any challenges, anything like that from a cash flow point of view. But in West and South Yorkshire, it's got good cash flow, enough that you're not going to be worrying about ongoing costs, and a really strong capital growth area. Really important, by the way, spend some time researching what yield means. Yield is risk, okay? So, for example, in Yorkshire, I could find a 12% yield property. I can promise you it's a terrible location, will get trashed all the time, and very low capital growth. So it's finding that balance. The higher the yield, the worse the area, almost definitely. The lower the yield, the more confidence in the area, but we want to be in positive cash flow. So 7% for me in West and South Yorkshire is a key performance indicator for success. I don't just chase the yield, we're chasing capital growth. We're looking at long-term value. I'm a big believer in price is what you pay, value is what you get for everything in life. And the same can be said for property. Like I said, when I'm finding most properties for me and my investors, it's not easy. Like 7% is difficult in the areas that we focus on. And I have to fight tooth and nail and negotiate with about 20 other people, even if I'm direct to vendor. What? Why would you want to do that? Because if I'm fighting tooth and nail with 20 other people, guess what's happening when I am renting the property? There's going to be a load of people that want to rent it. Likewise, whilst I'm not going to sell this property because my exit is death in many years, hopefully, I want the property value to go up. Well, how's that 20 people trying to buy your property, Jamie, going to impact that? Well, if I own the property on this street and they really want this property, it's not so much the bricks and mortar that they want, it's the location that they want for the purchase price. And so, when another property comes up on the street a year later, 20, 30 people are all bidding for that. And the more people that go in, each time the next one sold, it sells for more. It increases the average value of the houses on the street and it goes up. And that is known as capital growth. And we are looking for strong capital growth in the areas. So look, we're not looking for insane levels of growth that are unsustainable, but something conservatively that we know we can hit that 4 to 5% consistently year on year. Now, there's the local economics that are going on. For example, how many people are going and competing for the house, logistics around, maybe there's some hospitals, a school, good or outstanding on Ofsted within a 5-10 minute drive of the property. All of these things contribute, and then I'm looking to manipulate it even further by understand what sort of planning has been submitted in the area, what plans have the council got for this. And there's a great example of Stainforth. Stainforth's a great example. 5 years ago I invested heavily in Stainforth, and I had even my contractors who lived around the areas going, why would you buy here? It's a beep. Right, and it's like, well, actually, it's got a huge development going on, thousands of jobs getting created, and they're like, what are you on about? And it was literally a stone throw from their house. They had no idea about it because you see it online, you see it in publications, you see it in the planning portals years before the reality of a spade going into the ground. And it's really important to understand that analysis about the property is actually analysis about the area and trying to predict the future, but not with a magic ball, with hard, cold facts. Next, we've got the type of properties. There's so many in England. Why don't I focus on what to buy rather than what not to buy? Caveat to this, I am not talking about city centre locations. So for example, if I were investing in London city centre, which strongly advise against right now, video for another time by the way, I obviously would invest in flats because that's all there is. Outside of that, 2 to 4 bed, freehold, terrace and semi-detached properties. Why 2 to 4 beds? Because I'm looking for young renters, maybe families, young professionals that are looking to stay there for long term. I'm looking for longer term tenants, and it is proven again and again that 2 to 4 bed has the highest rental demand, at least in the areas that I'm looking at, but most of the UK. Next, freehold. If you don't understand the difference between freehold and leasehold, with a freehold, you own the ground that the property is on. Leasehold, you are leasing the ground that it's on. And I don't like the idea of spending hundreds of thousands of pounds or building a multi-million-pound portfolio when I don't even own the ground that the property is on. Sounds a bit silly in my mind. So freehold, I want to own the entire asset, not be renting the space from somebody else. Hence, ground rent when you have a leasehold property. Next, why terrace or semi-detached? Because, again, they're the highest demand in the areas that I invest in. Detached properties are lovely and great for a family, but people want to buy them and live in them. They're not typically rental properties, and terrace and semi-detached properties will attract the most demand, which, again, demand here, supply there, prices go there. That's why we go in with that. But they're the types of properties. What about the areas? Well, we focus on Vine Street properties. Yes, I'm talking Monopoly. We use a lot of Monopoly language at Aspire, but it's really important that on paper, the best properties look like Old Kent Road. Like if you think of Old Kent Road, the worst investment you can possibly make, they actually look the best on paper because you don't take account of capital growth. You don't think about tenant types that you're attracting. You don't think about all of the things that go wrong. What looks like the best investment visually in person is Mayfair. What beautiful properties. I would love to live here. It's like, yeah, but you're not living there. And so it's really interesting, isn't it? It's like, in theory, they both look like really attractive investments, but actually, I want Vine Street. I don't want to walk down a street where I might get shot, but I might buy a house 10 streets over. All right, so we're looking for Vine Street properties, the best investments and balance on the Monopoly board and real life for both rental yield and capital growth. I'm looking for a property that's got rental potential. Buyers are buying in the area, which is driving up the capital growth and the purchase prices. But ultimately, I'm looking to buy a house that somebody else can make their home, that's going to be a great return on investment and feel-good factor of providing that home for somebody. So there's a few things that I look at. I'll give you a couple of them. Looking at the employment rate and crime rate in any area is really important. I'm looking for the logistics in the area. For example, if somebody doesn't have a car, a lot of people that are buying property find that strange, but a lot of families don't have a car, especially in rent households or less of them. So looking at bus stops, train stations, logistics, if somebody's got a job in the city centre, how long does it take them? What shops are nearby? And one of the others that's really important is schools. Look for good or outstanding schools within a 5 to 10 minute drive of the property. And it's really, really important. Final one I'll give you, because there's so many more, is what's the average household earnings compared to the purchase price of the property. And we're looking for certain ratios of earnings versus purchase prices, because again, it gives a really good indicator of affordability for the properties. If the property is affordable, factually they can pay more, so there's no current capped limit based on affordability in the area. By the way, there's so much stuff that we look for, and it's not just the product, it's not just the property, it's not just the area, it's the service around it. And if you'd love to have a chat with that, I'd love to too. What we do at Aspire Portfolio is we build portfolios for people just like you. So who are we looking for? We're looking for somebody with 100,000 or more to invest, because we're not just looking to get one property. We want to build portfolios for you. We want somebody that loves boring vanilla buy-to-lets almost as much as I do, but maybe you don't have the time, the experience, the expertise, and you really want to make this work. You can't afford to get it wrong. If that is you, put portfolio in the comments. And what I'll do is I'll send you a link and you can book in a phone call. And on that phone call, we'll go through where you're at, where you want to get to, and give you some advice and all of the detail that we look for when selecting our investment. And if you think it's right, great. We will personally help you build your portfolio this year. And worst case, you've got some data that you can take away with you and start building your portfolio. But if you're ready to take action, or at least have a conversation, and you've got the 100K, put portfolio in the comments. I'll send you a link as soon as I can, and we look forward to having a chat. I hope this has been interesting, because a lot of people ask, why is it 7%? Why do you buy in that area, not in that area? And hopefully this gives you a little bit of insight. Any questions, let me know. If you did get value, the like button's there. Takes 2 seconds, actually does have an impact for me and the team. And if you're not subscribed to the channel, it's the #1 way of getting reminded of the next videos that are coming up on property, investment, and of course business. Hit subscribe and the notification bell, and I'll see you in the next video.